Okay, so now that we figured out the accounting equation, kind of how it works, we're going to start looking at how we record transactions in that accounting equation. We can check to make sure we balance after every single one, because we always should balance every time. As I said before, if we don't balance, we have done something wrong, period, because the accounting equation should always balance. The other thing about the accounting equation is, if it's a brand new company, a brand new organization like the one we're getting ready to deal with, all these accounts start off as zero. Okay, you can't start with anything in your accounts if you're a brand new company, a brand new organization. So I just went in and filled out some of the headers that are going to happen, but all these are is different account titles. So cash is an account title, accounts receivable is an account title. We'll talk about what they all mean. Accounts payable is an account title, common stock, dividends, fees earned, wages expense, utilities expense are all just accounts. Okay, the titles of the accounts, and they're how we know where we put things. So the first transaction, it says Chris Clark deposited $25,000 in a bank account in the name of Net Solutions in exchange for shares and common stock in the corporation. So remember, we are doing accounting for the business, okay, not Chris Clark himself, but the business. So this person, Chris Clark, put $25,000 into the business. So this is transaction A. Put $25,000 into the business and gained some equity out of that because he bought common stock. So cash would go up by 25,000. Format all these commas here. And common stock would go up by 25,000. So now we can do a balance line and make sure that we balance. Obviously, with only two, it's pretty hard to not balance. We started with 0, we have increased 25,000. Started with 0, increased 25,000. So my total assets is 25,000. My total liabilities is nothing, and my stockholders' equity is 25,000. So I balance. Assets equal 0 plus 25,000 in this case. So hopefully that's simple enough. Remember, we're only recording the report for the company itself. Next, it says Net Solution paid $20,000 for the purchase of land as a future building site. So what happened in this transaction? They paid something, and whenever we see that word paid, that means that money went out, and so that means that cash went down. So they spent $20,000, which means now my cash balance, well, we'll do the balance in a second. And what did I receive in this case? Well, I received land. So I actually didn't add that one yet, but I'm gonna need to. And what's the value of that land? Well, I purchased it for $20,000, and we do historical cost, so $20,000. So now my balance, my cash balance, this is transaction B. Transaction B, the balance line. 5,000 is the balance in my cash account. 20,000 is the balance in my land account. And 25,000, because it wasn't changed, is still a balance of my common stock. So now, again, in total, 5,000 plus 20,000 is 25. I don't have any liabilities, plus shareholders' equity, common stock of 25,000, and it all balances. Okay, so moving on, the next one, and this is where we get into something a little bit more complicated. It says Net Solutions purchased supplies for $1,350 on account. Okay, well, on account is a phrase you're going to see a lot. You're going to see it quite regularly. And all on account means is that instead of giving cash right now, we said we'll pay later. Now, this can go both directions. Either you can be the one who is paying later, or you can be the one who is getting paid later. But on account always means that cash did not change hands then and there. So if cash didn't change hands, like it says, it's Net Solutions purchased supplies and agreed to pay the supplier in the near future. Sorry, in this one it doesn't say on account, but it will basically from this point forward. So I make that point here because it will say the word on account, and that just means that you're agreeing to pay in the future. So what do we receive? Well, we receive supplies, and what are supplies? Something I'm going to use in the business. Now, that means it will become an expense eventually, but right now, just buying the supplies, just buying the paper and pencils and everything like that, that's an asset because I own it. I haven't used it yet. So I received $1,350 worth of supplies. Cash was not affected because it says I'm paying them later. But what happens? Well, I said I'm paying you later, but I've already gotten my supplies. So what does that mean? It means I owe them money. And what type of account do we use for owing someone money? We use a liability account. Specifically, short-term liabilities, the most common short-term liability is called accounts payable. And just exactly what it sounds like, it's money that I owe. Okay, we'll have accounts receivable eventually too, where it's money that is owed to me. But the liability side is accounts payable. So that liability goes up by 1,350. So let's do a balance line. Cash was unaffected. My land is still 20,000. My supplies is now 1,350. So now I've got a total of 5 plus 20 is 25,000. 26,350 is the total assets. And then 1,350 plus 25,000, my total over here again is 26,350. So my equation balances. Liabilities plus stockholders' equity equals assets. Okay, so I'm balancing. So we'll stop there for now, and we will continue with this problem in the next video.